Professor Siegel, is Mr. Kudlow right to pour scorn on the idea that a recession is not in sight?
It's not in sight. That's true. And by the way, Samuelson's quotation was 50 years ago, and he was right about 9 out of 5. And Steve Leisman was right. It's almost, we've had 3 or 4 recessions since then, yet about 7 or 8 bear markets. So it's certainly no certainty that even a bear market predicts a recession. However, the market is clearly worried about over-tightening of the Fed, and I expect Chairman Powell to either make a speech or indicate in the next FOMC meeting that the Fed is going to substantially slow down its rate of rate hikes in 2019. I think that the market is telling us something. The market is saying that the pace is just a little too fast. It's not strong enough to take a 3.5% Fed funds rate or higher next year.
Jason, do you agree? I assume you don't predict any kind of recession because you've really liked stocks.
Yeah, that we don't think a recession's likely in the next 12 months at all. I think the probability is actually lower than normal. It's true when you go out to 2020 that probability rises, but that's kind of getting back to sort of like a long-term normal average. I think another thing that's important to look at when you think about the relationship between the stock market and the economy, the annual correlation between like annual GDP growth and stock market performance is close to 0. So you can have years where growth is really good and markets underperform and vice versa. So the fact that the markets might be pulling back in a year where growth is actually good, that's almost sort of a historical norm. You don't have a great relationship between the two. But when we look forward, think about this morning with the retail sales numbers that came out, market didn't like it, but top line growth looks good. Sales for Christmas season look like they'll be up 5%. Maybe the earnings aren't going to be quite as good, but at a high level, the economy is doing well. So it's hard to kind of look at how the market's performing and think this is telling us too much about how the economy is going to do over the next 12 months.
Jason, do you buy or sell U.S. Treasury bonds at the moment? Some people seemingly suggest that they think rates have peaked for the medium term at least.
So it depends obviously what part of the curve you're talking about. If we think like 10-year or sort of longer duration, we think they're going to be trading in a range of where they've been recently. So on the 10-year Treasury, from like around 3 to 3.3%. So we're kind of at the lower end of the range, so perhaps buying and adding duration exposure. At this point in time, we're kind of getting a little tight. As a structural component of your portfolio, though, I think having some longer duration in general is good at this stage in the cycle, because if we do get a more material slowdown, if we're kind of wrong about our growth, then you're going to see rates come down. As Jeremy alluded to, the Fed will probably dial back expectations, and you get a rate fall, and whatever you lose on equities, at least the fixed income component, if it's longer duration, gives you some of the protection in your portfolio.
So Jeremy, it sounds like you see the Fed, taking a pause, reacting to the current market volatility and slowing down a bit, and then what? Then does the market rally? You think that's going to be good enough?
Well, first of all, we have a month almost. It's December 19th is the meeting. There's a lot of data coming in, but we do see a sign of slowdown. Look at the sharp decline in oil prices, in commodity prices. My prediction is the PCE deflator, which is the price index the Fed uses to judge inflation, is going to drop below its 2% level in the next announcement at the end of this month. It might actually drop as low as 1.8. I think that's going to give ammunition to the doves out there to say, hey, guys, let's not overdo it. There's a lot of wobble. Look at the international situation, and that was shocking. Negative growth for Germany, negative growth for Japan. We don't want to overdo it when there's no inflation whatsoever on the commodity or price front. And I think that's going to resonate at the meeting with Powell. And if he does say something before or afterwards, that's going to give the market, I think, a lot of relief.